Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham. This is episode 31. In this week's episode, let's just talk about this crazy market that we've had the last 2 weeks, right? There's been a lot of ups, a lot of downs. Let's talk about what are some strategies you can use to put some trading rules in for yourself, how to best position your portfolio to make sure that you can stomach some of the ups and downs that are going to happen and are going to continue to happen as this year goes on. So I hope you'll join me on the other side. Let's get to work. All right. Well, welcome back to the program, everybody. It's nice to kind of catch up with you. I haven't really had a normal episode, if we want to call it that, in a couple of weeks. We did the goal episode. We had Lee Michael Murphy on last week. And so this is kind of my first chance to really talk to you about what's happened with the market as we start 2022. It's been a little crazy. The markets are already negative for the year, right? So the Nasdaq's down a little over 4%, S&P 500's down 2%. And so we've had sharp up days, sharp down days, and that volatility is likely to continue. So we've had episodes in the past where we talk about interest rates, and I assure you, by the end of this year, you're going to be tired of me talking about interest rates. You're going to be tired of everybody else talking about interest rates, but it's something that you need to be aware of just to be able to understand why you're seeing the volatility. So you see Jerome Powell come out this week. He's doing his Senate confirmation hearings. He talks about how there might need to be 3 rate hikes, and that was less than the market thought, so the market goes up. Then you see some of the people that he works with the Philadelphia Fed. They say, wait a minute, we might have to do 4 rate hikes, and then all of a sudden the algorithms go back to work, and so the next day stocks start to drop because interest rates are going to go higher. So, this is really something that you got to take with a grain of salt, because you don't really know how many rate hikes they're going to be, how fast they're going to be, how quickly they're going to come. And if you're making short-term moves based on that, you're probably going to make a mistake. And so if we look back, if you listen back to previous episodes where I discuss making sure you understand what you own, making sure you like what you own, this is a perfect scenario for why that has to be the case. If you're looking at the stocks that you own and you see something that you're not comfortable with, you got to figure out how to get out of it, what you're going to do. I mean, the companies that you currently own are the companies that you're saving or working towards investing in, every paycheck or every time you get paid. You got to be making sure that it's stuff that companies that you really want to be invested in. And so, it's been a long time since we've had rising interest rates. And by the way, it's not like the Fed is wanting to take interest rates to like 5%. I mean, they're talking about maybe being at 1% by the end of the year. So if it takes them 3 rate hikes to get to 1, or if it takes them 4 rate hikes to get to 1, does it really matter that much? I'm not really sure, but the market, commentators on the market and short-term traders always have to have something to trade on. And so this is kind of the big one right now. So as we get later, as we get deeper into January, you'll start to have companies report their earnings on the fourth quarter, and that'll be more interesting to see what kind of impact it's really having on companies, or what companies remain profitable. I think one of my favorite kind of misnomers is that you'll hear people just say tongue-in-cheek, they'll say, well, technology companies don't do well in times of inflation. And my argument to that is, well, the last time we had rising inflation, if you look at the consumer price index this past week, it was at 7%, which is the highest, or 7% annual, which is the highest rate it's been at since 1982. most companies, when they say technology companies, they weren't even around back then, right? There was no Google in 1982. There was no, Microsoft. There was no Amazon. There was all Facebook. All these technology companies you think about, they weren't around back then. So we don't really know how they're going to handle higher inflation. I mean, there are a couple things that we do know, right, that we've discussed already, that if you have a lot of debt, then rising interest rates can be bad for you. If banks are repricing your lines of credit and things like that every year, that your more of your profit will go to paying down that debt. Yeah, that is a problem. But, we'll see. We'll see how this goes. I think in the grand scheme of things, and what I always argue with the people that I discuss this with, is good companies, great companies, always figure it out, and they figure out a way to prevail. So no matter what's going on, I want to make sure that my portfolio is built with companies that are great and companies that I want to be invested in for the long term. Now, if you're holding a bunch of stuff that you don't know about and you don't know how they make money, right? That's our number one. How do they make money? Then it could be a problem for you, right? So, make sure you understand what you own, and we'll see kind of what ends up happening with all this inflation stuff. Also, go back and listen to, or think about episode number 1, where I had you think about the $100,000 portfolio that you want to own one day, right? What companies are on that list, and start looking at where their prices are now versus where they were. And that should help you start to look at, okay, which of these do you think is a good deal? Which of these do you think, might not be such a good deal from when you made that list, right? And this is why paying attention is important. This is why monitoring what's happening in the market is important, so that you can look and see, okay, is this something where I want to take advantage of the market potentially beating this company up because of, interest rates or whatever. So I know there's a lot of young listeners of this podcast, and there's a lot of kind of growth stocks, if you will, some of the best performers over the last 2 years that have been beat up tremendously, 30, 40% down from where they were. And some of the worst performers from last year, namely AT&T, is already one of the best performers for this year, right? So AT&T's been beat up over the last couple years, and now it's starting to look pretty good. It's actually starting to have a pretty good year. So this is why diversification, owning more than a couple stocks is important. You don't have to own a ton, but having that list together is really important for you. And so, when you're looking at this, you have to come up with some rules that you're going to implement, basically to kind of protect you from yourself, right? So our biases, our emotions start to betray us when times get rocky. And so, when you have the market going up one day, down the next, and you have this gyration, if you're watching that every single day, your portfolio will actually start to appear riskier to you because you're seeing every move up and move down. So, you don't want to get in the habit of constantly watching every single tick up and every single tick down, because when you do that, you'll be more likely to sell out. So instead of, concentrating on the value or how much you're making or losing every day, I mean, that's just not a good way to think about it. Think about, okay, this is a really good company that I want to own for the next 5 to 10 years. And I'm going to try to accumulate as many shares as possible between now and 5 years from now. And so if you have that kind of mindset, you'll be more likely when it drops to say, oh man, I get to be able to buy this stock at a better price today. I get to be able to buy this stock at a better price. And so, by thinking that way, instead of just wondering if I made money today or did I lose money, you can really start to safeguard your portfolio and prevent yourself from basically getting scared out of it. And so that's what makes investing in the stock market so different from so many other asset classes, right? Because if we're thinking about real estate, you don't drive up to your home every day and it have like a number above your house telling you what your house is worth every single day. right? There's not, most assets, there's not something that's telling you what it's worth every second of every day. And there's not commentators like me on, podcasts, TV networks, everything telling you whether you should buy or sell your home every single day. But the stock market is different in that there's constant commentary, constant calls to action to do something. And sometimes you just need to sit on your hands. Sometimes you just need to sit on your hands, take a breath and say, okay, I'm just going to let the market figure out what direction it's going to go here. And I'm not going to make any moves. I'm going to, stick on the path, stay where I'm going. And I'm going to believe that, the decisions I made in the past are going to pay off. Because it's not like somebody makes an investment in a stock and goes, man, I really hope I lose a lot of money. Nobody thinks that. Everybody's thinking I'm investing in this because I think I'm going to make money. And then they get scared out of it. And then all of a sudden, when you get scared out of it, you sell a stock, that pain goes away immediately because you're like, oh, okay, the pain's over. But then the stock goes up and you go, man, my goodness, I should have stuck with it. And the reality is that we're twice as affected by a loss as we are a gain. And so the prospect of us losing money is so painful that a lot of times, we can't handle it and we want that pain to stop. So, when you start off a year like this and it's a volatile year, this is the most volatile start to a year since 2016. And, sometimes you just got to sit on your hands and you got to be a little patient, right? Warren Buffett has always said the stock market is a way of transferring money from the impatient to the patient. And you got to practice a little patience, and that can go a long way in helping your portfolio long term, because it's usually not big decisions that you make that impact your portfolio performance. It's usually little mistakes, this 1% here, 1% there, and then all of a sudden those little percentages add up to a lot later on. So you really got to be careful that you're not making those kind of mistakes. So if you've listened to this podcast for any length of time, you'll notice that there's a couple themes that we keep talking about, right? So we talk about basically investing in yourself mentally, physically, and financially. And, going back to that patience topic that I just discussed, really when it comes to investing, it's all about patience and discipline. Patience and discipline. Discipline being the consistency of saving money. But also when you look at the goals that you've heard people talk about, as you see and hear some of the interviews that are going to be coming up on this podcast, it's really about investing in yourself mentally, giving yourself good thoughts, listening to good things, reading good books, and then having the physical component of that as well, and then financially. And I truly believe that if you have good habits throughout, mental habits, physical habits, financial habits, you'll be successful. And that's really what investing in yourself is all about. I want you to bet on yourself. And so as this year goes by, as we start having more guests come on the podcast, that is going to be the theme that you're going to see as we kind of transform this podcast. It'll be financial topics, mental, maybe some physical. But that's really, it's so important because like if you have the goal to wake up early and go work out, if you go to bed late, it's not going to happen, right? So are you getting enough sleep? Are you, watching things, reading things, listening to things that are helping your mental framework, or are they harming it, right? So, you have all of these things work together. Good habits create good habits. Bad habits create bad habits. So, as we look to build out your financial world, we're going to do it through helping you mentally, physically, and financially. And if you can do those things well, man, hopefully you're going to have a great life and be set up in a great position to win at whatever your goals are. So, I want to talk about one stock this week, kind of the stock on our radar. But before I do that, of course, I have to remind you that this podcast is for entertainment purposes only. I am not your financial advisor, so consult your financial advisor or do your own research before making any investment decisions. And future past performance is not indicative of future results. So you'd think I'd be better at like saying that by now, but nope. So some of the feedback I've gotten on some of the stocks that we have discussed in the past is that, hey man, you got anything that's under $100? So I got one for you this week. This is Plains All American Pipeline. The symbol on this one is PAA. And they are a pipeline company. So think of it basically as a highway for oil and gas. They get paid for oil and gas going through their pipelines. And the stock is currently at $10.95. If I were you, I'd be trying to get this under $10. I will say that. I would try to, put this on your watch list and try to get it under $10. It does pay a great dividend at 6.73%, which is a dividend of 72 cents a share. But with oil staying above $81 a barrel, they should be just fine. So this is one of those where when you invest in oil stocks, you have to understand something. And that is that the oil and gas industry is very, very expensive. It is very expensive. There's a lot of capital that goes into it. And everything's great when oil is high, and then everything's horrendous when it's not. So this would be one of those companies where, if oil were to go back below 60, you'd have to reevaluate it. But one of the reasons I like this stock, and it is a stock that I own personally, I like it for the dividend play. I do own it under, my cost basis is under $10 on this stock. And I really use it as an income generator. So I have it on dividend reinvestments, right, which we've talked about on the podcast before. I have it on dividend reinvestments. And so I just have, every time it pays a dividend, it just buys me more shares, right? And so, at this rate, if you get it under $10, your dividend yield is going to be closer to 7%, which means you'd probably double the amount of shares you had within 10 years, even if the stock stayed right at this level. So I like the fact that I can get paid money to wait for maybe oil to stay at this level. If oil stays at this level, they're going to do better. So that is really, the stock on my radar for this week. Their financials, when you're looking at those, they're going to be a little bit different for an oil and gas company. I'm pulling them up right now. So I'm looking at their assets. When you look at the assets of an oil and gas company, one of the problems is mainly going to be that a lot of their assets are probably going to be tied up in equipment, which we talked about during the balance sheet podcast. And so you really have to pay attention to their debt, because obviously, if you have interest rates going up, which we just talked about, that can make their debt more expensive. So with an oil and gas company, you have to, it's kind of this, I'm not saying it's a game of chicken, but you have to pay attention to, do they become profitable with oil and gas being at high levels? And does that offset the debt or their interest rates going up and their debt becoming more expensive? And can they sustain this dividend? So this is, one of the reasons I picked this stock is because it does provide you with a kind of a challenge for you to go in and do some research on this kind of company. With oil being up, and we haven't talked about a lot of oil stocks, and because I'm located in such a oil and gas heavy place, I normally, in portfolios of my clients, I kind of stay away from a lot of oil and gas companies because we're just surrounded by it. And there's something called home bias, which you have to diversify kind of away. So, but I do want to put this one on kind of your, in your circle or on your radar to be able to go look at it, because you can learn a lot by analyzing the financials of an oil and gas company. So, that's kind of your assignment, is to go look at this and see if it couldn't be something that you want to look at. So you never want to invest in a company based solely on the dividend. That is not a good thing to do. A lot of times, if a company is paying a super high dividend, they a lot of times don't have enough money left over to invest back into the business. So that is something you have to be careful with. But with this one, I think you kind of get a good mix, risk reward, and it could be something that maybe, if you can start a small position, and it's at a price point where a lot of people can make this happen for them. So Plains All American, go check it out, do your own research on it, and let us know what you think. So as we wind down this episode, I wanted to make you aware that next week on the podcast, we're going to have a real estate expert. Zach Booth is going to join us. And so we'll get some of your real estate questions answered, and hopefully, just continue this, getting experts from other fields to come in and talk to us about investing in their particular line of business. So I appreciate your time as always. I appreciate your shares and your likes, and we've gotten more reviews. So I appreciate you reviewing the podcast. That really helps. Apparently we're like in the top 10% of podcasts worldwide already, which seems crazy to me, but I really do appreciate it. So we'll keep it going. I hope you have a great week. Don't mistake activity for achievement, and I'll see you next time.